Hello and welcome back to the Naked Expat channel. Today I'd like to talk about a major change to British inheritance tax, how this affects British citizens with foreign spouses, what exactly has changed, and how not to fall into the non-residency trap. In what may be the most important tax reform in decades, British expats have just been granted a remarkable degree of freedom from UK inheritance tax, IHT, and the implications are profound. As a senior investment advisor at Hargreaves Lansdown and subsequently with my own investment practice in the UK, I experienced firsthand advising clients across the world how the outdated domicile rules in the UK created a considerable amount of legal complexity and expense for British families living abroad. Until now, the UK's tax regime, the inheritance tax regime, operated on a notoriously ambiguous concept of domicile. It was a status that could follow you for life, regardless of where you lived, paid tax or held assets. For many of my clients, especially those with international spouses, say for example in Thailand or the Philippines, and globally held assets in portfolios, this meant that 40% of their worldwide estate remained at risk from inheritance tax, even if they'd lived outside of the UK for decades. That all changed on the 6th of April 2025, when the UK government replaced domicile-based IHT rules with a new residency-based framework, a move that finally brings logic and predictability to cross-border estate planning. So, what exactly has changed? Well, the key updates under the new rules are as follows. UK liability to IHT, or inheritance tax, applies if you were UK resident for 10 out of the last 20 years. Once you've been non-resident for 10 years or more, your non-UK assets fall outside of the UK's inheritance tax net. There's no more lifetime deemed domicile status, which would have otherwise tethered you to the UK tax system. Now, this is where you need to be very, very careful, and I'll touch on this in more detail at the end of the video. In plain terms, if you have genuinely left the UK, this reform is nothing short of a generational reset. This change finally allows British expats to plan with clarity and not just complexity. For those who have built lives and legacies overseas, it offers a clean break from the outdated presumption that the UK always has a claim on your estate, even if you've been out of the UK for 10 years or more. This shadow now lifts. So, how do these new changes affect British citizens with foreign spouses? Previously, if you are a British citizen married to another British citizen, either through marriage or civil partnership, assets between spouses on death are inheritance tax free. The problem was, assets between spouses when the spouse was not a British citizen was only inheritance tax free up to the nil rate band of £325,000. So if you had assets in excess of £325,000, even though you're a British citizen, you're married to an overseas spouse, anything above that £325,000 nil rate band threshold was subject to 40% inheritance tax. Completely unfair, because if you're British and you married a British person, there was no inheritance tax between spouses. But if you married a, say, Thai or Filipino person, then only £325,000 of your estate was liable to be inheritance tax free. The remainder subject to 40%. Grossly unfair. Under the new regime, it's now changed. One of the most problematic areas under the old rules was how estates were treated when passing to a non-UK domiciled spouse. In order to avoid inheritance tax, you then had to create complicated trusts in order to remove assets in excess of £325,000 from your estate, place them into trust. Bearing in mind, with UK inheritance tax, it was based on your worldwide assets, not just those in the UK. Under the new regime, things are a lot more straightforward. Couples can now structure ownership to keep UK assets within the £325,000 nil rate band, while all of your global assets are outside of the UK and therefore not subject to UK inheritance tax anymore, which is fantastic news. For many folks, this reform fundamentally changes the equation for inheritance tax planning. Let's be clear, this is not about tax avoidance, it's about legal tax mitigation via clarity, strategic control, and tax fairness. And it comes at a time when global citizens are demanding such fairness. Now, finally, I mentioned earlier about making a clean break from the UK. This is where you have to be very, very careful, because under the HMRC wording, you have to have shown that you have genuinely left the UK, and not only just been outside of the UK for the last 10 years or the last 10 years in the previous 20, but also you need to prove a clean break. Now, I've had personal experience with a high net worth client who had to take the HMRC to court to prove that he was actually non-resident and he was a true expat. And believe it or not, the onus is on the individual to prove to HMRC that they are an expat, not the other way around. So it's almost like you're guilty until proven innocent. One of the issues can well be, well, what makes a lot of logical sense is maintaining a property in the UK, renting it out through an agency or whomever. It's in your name, and then you enjoy that rent to spend the money in, say, Thailand or the Philippines or wherever you live, Spain, Portugal, and you use that rental income as passive income for your retirement or your new life abroad. Well, you have to be very, very careful here, because HMRC can say, well, you've not made a clean break from the UK because you still own property in the UK, therefore you still have a foothold in the UK. There was even a case a few years ago where an expat fell foul of the clean break rules. He had no property or significant assets in the UK, but he maintained a UK phone contract with Orange, now EE. And because of that, HMRC were able to prove that he had not made a clean break from the UK because he maintained a phone contract with the UK, and he maintained that contract simply so he could get messages to log into online banking. It was that innocent, but he fell foul of HMRC in court and lost his case purely because he had a phone contract. That's why in many instances, it's very advisable to have a pay-as-you-go rather than a proper contract with a telecoms provider, because it's more of a clean break. It's not a contract which binds you to the UK. So be very, very careful with properties that you rent out. You're better off as a British citizen, even if you're living in, say, Asia, where you can't legally own land, you're better off buying a property in Spain and renting it out and enjoying the rental passive income in the Philippines or in Thailand, rather than owning a property in the UK, which would fundamentally tie you to the UK, and the HMRC could prove that you have not made a clean break from the UK. If your estate is less than £600,000, then all of this is somewhat irrelevant. However, you've got to bear in mind that between spouses and with property prices on the rise, it's not difficult for a lot of people to fall into the inheritance tax trap and to start being liable to inheritance tax. I hope you found this of interest. It's potentially fantastic news for British expats living abroad, and it's an important subject that you need to consider. I welcome any comments in the comments section below, and I've provided some links to articles on my website should they be of interest to you. Thank you.